Hello, everyone. Very excited to go over the December monthly market update. And even more excited to have a new guest with us this month, Derek Campbell. Welcome to the webinar.
Thanks for having me, guys.
Absolutely. So let's go over to the slide about Derek and his team. And Derek, anytime we have somebody new, we like to better understand a little bit about your journey to getting where you are today and why you're passionate about the business you're in.
Yeah, for sure. So kind of a roundabout way, I've always wanted to get into real estate. I went actually to college for one of two places in the country that offer general real estate studies. So I've always kind of wanted to do it. I graduated, moved down here, worked for an investment banking company for a little bit. Realized that that kind of wasn't the route for me. I ended up joining a large wholesale shop in the area of Houston. Worked my way up to general manager over the course of about 5 years, and then my wife and I started a kind of large scale flipping business in 2019. We did about 150 flips over the 2.5 years that we were doing it. We still
Wow.
actively do some flips here and there, but our main focus is Vicina Realty right now. We are a wholesale shop essentially. So try to put our own little spin on it, but we do roughly about 15 deals a month right now, and we're just trying to focus on scaling that. So
Yeah,
So I'm curious. I'm curious. You mentioned that you guys did. It was a lot of. I don't remember what the number was, but it was a big number of flips.
yeah, it was like
Uh,
147. I say 150, I like to round up, but
uh, so we have folks that try and do a lot of flips. Do you have any tips for people that want to have that many deals going at the same time?
You really at that scale, because at one point we were doing like 6 projects at a time, and you're trying to do that many projects at a time, and what ends up happening is you end up getting stuck in the details of the closings in that. So I would highly suggest you have to really vet the team that you're with. You can't do it all on yourself. Every person on your team that you kind of implement has to have their own niche and specialties. You really got to vet the contractors that you're going to be working with. I've found personally that I prefer the contractor crews that are going to work in the specific property. So someone that's kind of like an owner operator who has 3 to 4 guys that work in the actual property with them lends itself a little bit more control because they're more invested versus just the GC that is going to kind of oversee everything.
mm,
Although if you're going to try to scale, you're going to need a GC at some point. So what we did was actually we had an in-house GC who managed those individual crews on kind of a full-time basis.
makes a lot of sense. So you said you like to put your own spin on the wholesaling business, and we've worked with a lot of investors who speak very highly of your team and the way you do things. So, what is your secret sauce? What do you do that's unique to other wholesale groups?
Um, to the point of where we can lend our experience and our knowledge, we try to do that as much as possible. And so I really spend some significant time training, whether it's someone who's coming into the industry with no experience. I spend a ton of time training those agents that come on board, and try to really get it so that we can kind of lend our, if you've done as many deals as we have, or you've seen as many deals as I have, you know where you can lose money. And I try to help and lend that knowledge to people so to help them avoid making the same mistakes that I did if I could. So,
Yeah. Um, One other thing I've noticed about Derek and his team, and if you're an investor out there looking to find high quality deals with someone who is not transactional and cares about relationships, I would really encourage you guys to seek them out because that's the biggest thing I've noticed is they talk about developing relationships and helping people succeed and doing lots of
yeah,
deals with an investor.
yeah,
And that's not always the culture at every wholesale shop. Some wholesale shops are very transactional. They just want to make the maximum on each individual
yeah.
deal, even at the detriment to an investor sometimes. And I really sense you guys are passionate about, you know, if there's something that has to be done, you understand that. and you really work to try and make it a win-win. So that's one of the reasons we really like working with your team, and a lot of the investors say that too.
Yeah, no, I appreciate that, Wade. It's we've been doing this for 15 years now. It's my wife and I who own the company. She and I have our reputation is all that you have in this industry. And if you burn people, if you burn bridges, if you don't allow people to make money that you're working with, then word spreads. So us being investors ourselves, we try to price the deal so that there's still some meat on the bone. Of course, obviously, we're trying to maximize what the market can get, but at the same time, if you don't price deals correctly and you're dropping too many deals or you're wasting too many sellers' time or not doing what you're saying you're going to do, you can't be in this industry long, or you're going to have to constantly be looking for new opportunities rather than cultivating your market that you're already working with. So,
Absolutely. Yeah, you and Kat are an impressive team, and we met a lot of your team. They're all very impressive. So once again, if anybody out there is looking to find good off-market deals, I think y'all are a great resource. Um,
appreciate that.
all right, let's go to the next slide. We're going to talk a little bit about disclaimer. No one at Catalyst or at Vicina is giving you direct investment advice. You must always do your own due diligence, and we're not accepting responsibility for any investments that do not go well. You, of course, are always responsible for your own investments. Next slide. I'll briefly talk a little bit about what we do in our value proposition for Catalyst. We are passionate about being a one-stop shop for hard money and long-term financing. We are real estate investors uh, who have built a real estate lending company. So, if you are passionate about working with someone like Derek talked about doing, 150 flips in a certain time frame. We've done hundreds of flips over the years. We own a large single family rental portfolio, and just like Derek, we're passionate about helping you succeed and candidly avoiding many of the mistakes we've made, because we've made a lot over the years. And sometimes if we can pay that forward and help you avoid them, that's something we're passionate about. With one credit pool, one soft credit pool, you can get pre-qualified for a very wide variety of products, including the hard money, purchase and repair distress real estate, conventional loans, and DSCR, non-conventional loans for your rental investment properties. But also, if you're looking to do a cash out refi on your primary, or you want to buy a primary and you qualify for jumbo loans, there's really nothing we can't do in the single family 1 to 4 lending space, and really provide a wide variety of solutions with some very well-trained loan officers who can help guide you through the process. We have some specialized products like a bridge appraisal, which really reduce your risks of being out of pocket more than you anticipate whenever you do a fixed to rent transaction. So we'd love to talk with you about all the things that we can do. All right. So next slide. Derek, I know you're based here in Houston, just like we are. What do you see in the Houston data, and what are you feeling in general about Houston?
I would say that you're for the last 3 to 4 months, it's getting a little tight there, and it's inventory starting to creep up. Traditionally, we have about 3.7 to 3.9 months average inventory. And I'm seeing a lot of, if you're actually tracking the withdrawals and stuff like that, the withdrawals have spiked significantly. I think it's a trend of the sellers. I think it's the time of year. I mean, I think we don't really put enough weight on the time of year sometimes in this industry. The holiday seasons is difficult. You got to really look at a year over year trend. But I think from this year versus last year, there's a lot of more people who are not getting the prices that they want, and that I think they're taking they're taking it off market to kind of maybe relist in another 6 months, hopefully in the summer, and try to get the prices that they're going to try to get. So,
Yeah, I think that's very true. Seasonality definitely plays a role. There's a few of my rental portfolio that I'm cycling through, moving on to some other investment opportunities. And I always remembered this. I haven't sold as many properties lately, but you get past Thanksgiving and things really
yeah,
slow down. They just
yeah.
they just do. If
We've
you're
only got we've only got about 2 weeks of true business days in December, so it's really tough.
Yeah. The good news is, if you're looking to flip properties or if you're looking to buy them, there's a couple good reasons to do it at this time. One, people can't sell in the traditional way. So if you're an investor, you can really provide a solution and get some excellent deals, because it is a buyer's market. And if you think about buying it now, spending 60 days on a rehab, you're going to be coming to market at a perfect time to come to market. Early spring is an ideal time to put properties out on the market. So it's a really good time to buy as an investor, while it is a difficult time to sell if you're flipping, right? Jeff, anything that you see jumping out in the data?
Well, it was pretty. I don't know if Derek cheated, looked ahead of time, or was just in tune. But like I always look at the sales versus listings because you're right. Like it's seasonal, but also you have to account for the fact that you look back previous years and like 6,300 sales is pretty in line with what happened the last year. And then we always, I know this is your first time on here, Derek, but we always have a last year number and we always have a pre-COVID number just to give people
Yeah.
some context
Yeah.
as to what, like a quote unquote normal market looked like. And so the total sales are extremely flat, even though
Yeah.
Houston has grown in population quite a bit. But what is not flat is the active listings. So to your point, this time last year, 6,500 sales out of 30,000 listings. Now we're at 6,300 out of almost 60,000 listings. So it's
Yeah.
almost 2x the number of listings for the same or slightly less than the same sales. So that tells me
It's
it's a great chance to take advantage if you're looking for a deal as
Yeah,
well.
and it's going to be with the government shutdown next year, Q4. It's going to be, if you're looking at the national numbers, it's going to be different as well because it's going to be heavily influenced by the fact that we don't have 2, 3 months of data. So just looking forward, just knowing that data, if you're looking at it, can be misleading. You got to kind of look at the underlying trends of what's actually occurring. I would say, in real estate investment in general, if the market shifts, you just buy deeper. It's just natural what it is. If Warren Buffett has that saying, be aggressive whenever others are fearful. And if you are truly able to do that, then you make a lot of money in the times. Right now, I would say people are fearful to buy, but that just means there's more inventory out there that you can pick through and be more aggressive at and get deals that, maybe during COVID, you're paying 82%, 80% for those deals that you can
Yep.
now get for 75% with no money out of pocket, keep it as a rental or keep it as a flip. And, the $20,000, $30,000 you would have spent 3 years ago, you can keep in your pocket. So
Yeah. No, it's a great point. I mean, we haven't even talked about it, but yeah, we did analysis on what the typical out of pocket was during COVID versus now, and it's night and day. I mean, everyone was an investor back then, and everyone was flocking to the cash flow, which was great. Don't get me wrong, but you were paying for it. Now you're able to pick up properties a lot less. Your cash flow may not be as good, but it's okay. It's getting better. If you look at the leases, over the last 6 years, it's gone up. What is that? Almost $500, I guess. So, I mean, on the long run, it'll catch up, right, sooner or
yeah,
later.
it's
You're,
just
you're
what I see from 2024 to 2025 is just it's increasing, it's slowing down versus what it used to be. And I think it's just it's market is correcting itself versus the low interest rates and the high demand we had 2, 3 years ago. I by no means think that the bottom is going to fall out. I think you just have to pick and choose what you're looking at a little bit more selectively. Um, and we can talk about, on the future slides about how I think that you can help your product um, survive this type of market.
Yeah. Last thing I'll say on this one, then we can move on to the next is like Houston, because you're going to see a little bit of correction, like you said, on pricing in one of the markets, and then the other market I think is correcting as well, but in a different way. But Houston has always been kind of steady Eddie. You never get like massive price swings in Houston, like you would say in Austin, Dallas, even San Antonio to a lesser degree. Like Houston is just it's so stable. And you can tell, when others are maybe dropping, even though all of these listings are out there, price is still pretty flat, right? Median's down 1, 2, but average is up 1. It's a relatively flat market.
I'll say two quick things. Um, One, Houston is very, very stable, to your point, and I think it's a market where uh, you just don't have the fluctuations in comparison to the other three major metros for sure, but even across the country. But to provide a little bit of data on the out of pocket and some another thought that I think is important to consider is that cash flow is an important number, but really the bottom line is return on investment. Um, any savvy investor really focuses on return on investment. Cash flow is kind of a simplistic measurement. It's easy for people to understand. I make $200 a month. I make $300 a month. But the bottom line is return on investment, which means how much you have to put into the deal versus what you make. And the ROIs at the moment, despite cash flow being lower, are significantly greater than they were during COVID. So back then, statistically, for an entire year, the average person was out of pocket 45K. Right now, on average, people are out of pocket significantly less than that. Significantly less than that. Like less than half on average for our entire portfolio. And that just makes a huge difference. So even if you're making half the cash flow, which is probably about where we are right now from that time frame, the ROI is far better. And once you're out of pocket on a deal, once you're out of pocket 45K, you can't get that money back. What you can do if you are a lower out of pocket like we are today is you can refinance into a lower rate, which we're going to talk about a little bit later on. Then your cash flow could double whenever the rates come down.
Yeah. Just one last thing. So we were doing working with another guy the other day and looking at properties, and most of them are pretty simple, 100, $200 cash flow. But if you're just like in a stock, right, you can diversify your real estate portfolio. There are good cash flowing deals out there. You just have to be willing to get smaller deals, or it's easier to cash flow on an ARV of 150 than it is of a $300,000 house. So you just have to be willing to accept the fact you're not going to hit an equity capture home run. You're not going to have a massive appreciation necessarily in the long run. But if you're nervous about having a lot of properties with minimal cash flow, go pick up one or two of the little baby properties that will increase your monthly cash flow quite a bit. You're not going to have the likelihood of a strong appreciation, but your other properties are. You can balance yourself out a little bit. Go get a bunch of a couple little properties that will jumpstart your cash flow pretty quick.
We call those the beater properties. Wade knows about that. The ones that cash flow better in the more risky areas. If you're going to have a larger rental portfolio, you have to have a mix of the appreciation ones, but then also the ones that are going to cash flow to kind of balance each other out for sure. No.
And then sometimes those areas that seem riskier and have big cash flow also end up being high appreciation. Like I got stuck with one back in, I think it was like 2012 or 13 in Sunnyside, and that place is way more than doubled in value. It's probably had the highest appreciation of just about any property I've had. So, sometimes
and if you can get a good tenant in there too, if you get
the
right tenant in there, then that makes the area moot. So,
yeah, I had the same person for like 7-8 years. So yeah, we got lucky on that one for sure. All right, let's talk about Dallas.
Just one note. Sorry, this is David. Put together a presentation. I wanted to make a note on the number here. The active listings actually for last year, 2024, were 48,525. So it was a year-over-year increase of about 19%. Not exactly that 18% that's shown on the presentation here. So I wanted to make that quick correction. So apologies for that. Going to move on. Still increase, not that much though.
Yeah, not as probably should have noticed that. Still not as gross, but definitely same concept.
All right. So in Dallas, Dallas has been a very interesting case. It still has the highest appreciation since COVID, but being down 8 and 6% year over year is pretty surprising. But it has been on a little bit of a downward trend. But this is the biggest jump I recall seeing, Jeff. I don't know if you feel the same way, but definitely feels like it's a significant buyer's market in Dallas right now, which is a good opportunity.
That's what I was talking about. It's like that's Houston pretty flat, +1, -2. Dallas had a pretty big negative jump this month, -8 and -6. But to your point, and Dallas had a big run up that Houston did not have. So if you look at it over the 6-year period, Dallas is +52, +44. Houston's still behind. Houston's +42, +35. So in the long run, Dallas is still ahead of Houston when it comes to price appreciation. for all the good fundamental reasons. A lot of job creation, people want to move there. A lot of companies going to Dallas, um, but it is starting to pull back a little bit. There's no doubt about that.
Yeah, I mean, if you're looking at it from a macro perspective, the income in Dallas and Houston are very similar across the MSAs. So you can see the home price is going to start leveling out as inflation increases, and people can't afford those homes that they were getting able to, you know, purchase in the very low interest rate year days. So you're going to see a little bit of a correction. It's never going to be the same as Houston, but it's going to affect it a little bit more.
I don't know exactly why, but the new listings there on rentals is a pretty shocking change. I'm not sure why there were so few.
Wow.
Um,
I
but
will
overall,
actually give some more information on that as well. As of this month, the reporting has changed for rentals for the Dallas metro area. So I believe their MLS system has shifted a little bit. So this actually focuses in on a much smaller area in comparison to previous years.
Maybe they took Fort Worth out
uh-huh,
and they
well,
separated it.
maybe so. Um, okay. I don't see anything else jumping out here other than the trend is, for months of inventory and days on market is going up. So I do think it's a real good buyer's market for real estate investors in Dallas. Um, like Derek said a few minutes ago, this does not mean it's a bad area in which to flip. You just have to buy at the right price. And like we've been saying for a long time, have a best in class product at a slightly lower than top of the market price. And we see a lot of investors still successfully flipping. You just cannot do like people did back in COVID and say, "Hey, I'm gonna pay a premium and expect the market to continue to go up." That would be a real mistake. You have to be very cautious, especially in Dallas at the moment.
I mean, so I'm a real estate broker as well. You have to look at the underlying where the data is coming from. And because the data is coming from the MLS, it is subject to the listing prices that those realtors are going to place on there. And there in Houston, there's 27,000 active realtors. And if anyone's ever worked with a realtor before, there's good and bad realtors. So you kind of have to look at, those realtors who are not doing that much business. If you overprice a property, it can significantly pull up the average. Or if you're not on top of the trends and you're slow to do the price reductions and to see the trends and you're comping stuff from the wrong period of time, it can significantly skew these numbers. And I see it all the time whenever I'm negotiating with realtors that sometimes just expectations don't match what the marketplace is, and so that data can be significantly skewed across the board in terms of days on market and stuff.
Yep. All right. San Antonio is next, and San Antonio. Well, I mean, there was a time a year ago where San Antonio was the market giving us on this webinar and many people across the state a little bit of concern, but it is the biggest success story year over year anyway, being up 5% on the average and the median. And the months of inventory and days on market are still a little historically high, but I assume with this momentum, that's probably going to start to pull back. But very surprising number there being up 5% year over year. Do you guys ever
Yeah.
do any deals over in San Antonio, Derek?
Every once in a while, the price points are very similar. They're, on average, $25 to $40,000 less than here. So if we can relatively price deals very similar to the Pasadena area and stuff like that in most of San Antonio. So every once in a while, I do have a couple connections there. San Antonio it has been for the last 3-4 years where a lot of the people that I talk to would like and prefer to invest in if it's not going to be in Houston.
It's a really good rental market, that's for sure. Like the price point's attractive, solid rent rates. The homes
Yeah,
aren't
you can
over.
see that the rents are over the last couple when the leased listings are increased, and in the last three areas were not. So, and
Yeah.
prices actually went up too versus Dallas
Yeah.
average lease price.
I mean, if you like Wade said earlier, San Antonio was kind of taking a beating earlier this year relative to the other two markets, but it's caught back up to a point where the pre-COVID number with Houston, it's flat, and the median is actually up a little bit more. So it's it was always kind of confusing as to why San Antonio was dropping like that. I don't have enough insight to know what the problem was, but it seems like it's corrected itself because the fundamentals are there, like you said, the income and the pricing, like just it's not that different than anything else.
Mm-hmm. I think if you're down in San Antonio doing deals, they do have a unique process with a group called the Strike Team. So just always keep that in mind. I don't think it's a reason not to invest there. You just have to bake into your numbers that you're going to have to pull permits on everything, and make sure that the property is not red tagged by the Strike Team before you get involved with it. That there wasn't any work done that was not permitted. Those are super important things. We've had a couple investors get into a pickle because of that. So you have to do a little bit more due diligence there. They are not just have people riding around in an unsophisticated way like they might do it in some other cities, just looking for people with a dumpster out front or something like that. They'll actually look at properties that are listed for rent or sale. And if there were not permits pulled and it looks like a big rehab was done, they'll come in and check things out in a little bit more of a scientific way. So just be very cautious there. Make sure you pull your permits. It's not that much more money, and you just really protect yourself.
Yeah, and even if you're doing the cosmetic lipstick job, a lot of people don't. My suggestion would be to throw paper over your windows, and keep the doors locked if your crews are there, and that because the inspectors and that they're not allowed to come in the property without your permission. So just tell the crews not to let them in. I would always suggest to use to do and pull the permits and that, but and nosy neighbors and people who want to see stuff, if you just keep that paper in front, it can keep people from, getting nosy and seeing what you're doing in the house too. And saved me a lot of headache by doing just, hey guys, just throw up that painting paper over the windows. So
Yeah, for sure. And I think Houston, Dallas seems like it's not nearly as you know difficult process. San Antonio in particular seems to be they have a little bit more aggression there for sure. All right, so Austin is up next. I know Jeff, you get down to Austin quite a bit with having some family there and stuff. What are you seeing down there?
Yeah, so Austin, much like the other markets, it's pretty flat, right? Down 1% with a median price. They don't show average for some reason, but months of inventory is 6.3, and I think that is the highest months of inventory. But Austin kind of already had its correction. They had a big run up with COVID, and a lot of the Californians moving to Austin. I think they had their pullback already, so it's kind of starting to flatten out and getting back to normal. I mean, if you look at it pre-COVID, it's still 430 as a median price is still the highest price in the market by a good bit. I mean, I think Dallas is second at 375, so that's still pretty significantly higher than Dallas is the most expensive market. So we don't do a lot of rentals there, but you can do flips or multifamilies. But it kind of seems like it's getting back to a normal. The days of market is still pretty high, not as high as San Antonio, but it's higher than it's been the last year and pre-COVID. But it's always going to be the most expensive, but it's not going through one of its crazy booms right now, I don't think, or busts.
Did you guys ever do any flips out of town when you were doing it, Derek, or did you focus exclusively on?
Yeah, I mean, so San Antonio, or I'm sorry, Austin has always been the most expensive. Builders are going crazy. I know they changed the law. I think it was 2 years ago or 3 years ago that you could subdivide those lots that weren't allowed to be subdivided before, because they were having a housing crisis. They didn't have enough homes in certain areas. So I think it's like 1250 now you can subdivide those lots down. So the builders, gobbled up a ton of that, the land. So anytime I've ever done anything, it's always been land in San Antonio. And so it's, you can see it's a little bit slower moving. It's actually surprising to me that their median price is only 430. I would have thought it was much higher than that.
Probably back whenever you were looking over there, it was because they had a huge run up, arguably the biggest in the country. during the heights of COVID, but then there was a big pullback. I think at one point it was even down 15% year over year. It's one of the higher numbers I remember seeing, but um, yeah, it was definitely a more peaks and valleys than any other
Yeah.
city during the past 6 years that we've been measuring this.
Yeah, I mean, if you
All right.
do townhomes in that, though, it's a great market if you can get a decent price on land. You just got to be prepared to hold it a little bit longer.
Yeah. All right, let's go to this next slide. And this is Forbes and the National Association of Realtors making predictions for next year. And they use this is a very scientific evaluation, two very credible groups that provide this information. And they are normally, one of the better prognosticators out there. They normally do a pretty good job on this. So they're saying that they project existing home sales to increase in 2026 up 14%. So that's a significant difference that really can help increase prices over time. Uh, Forbes analysts project 1 to 2% price growth nationally, while NAR estimates 4%. So it's some variation there. 4% is a little bit closer to the long-term trend. 1 to 2% would still be a good bit below the long-term trend. And one thing that is interesting is that mortgage applications jumped up 31% higher than a year ago. That's not a projection. That's just what has actually happened. But overall, I think there's a lot of positivity because of what is projected and has already happened to interest rates. For mortgage applications to be up 31%, that tells you there's been a lot of movement already in interest rates and that there's a lot more anticipated next year. Anything else jumping out here, gentlemen?
The only thing I would say is I think this whole theory is based on two numbers on there. One, and the most significant one is the mortgage rate. They're projecting that rates are going to drop 70 basis points over the year, and then job gains. Those two things right there are driving this. So if those two things happen, good chance that this prediction will come correct.
It's interesting that they have job gains increase that much, but then also unemployment rate rise.
Yeah. The
Is it more
unemployment
people
rate
coming back into the market, or I'm curious.
unemployment rate is a really weird number because it only measures the people who are actively seeking jobs. So
Looking, yeah.
leave the job market, they don't count into that number, which is so it's a little bit deceiving, honestly. The unemployment rate, we put a tremendous amount of stock into it, but it's kind of an odd number because some people just check out and don't try to apply for unemployment anymore.
Yeah.
So I think the job gains number is pretty crucial. But I think you guys have probably seen it. The inflation number was surprisingly positive, like a very good positive number. And then the unemployment numbers, actually, the last data that came out were not as good. So that is like something, those two numbers, because the Fed's dual mandate, lead us to think rates might come down even more quickly because the Fed wants to control inflation, make sure that we're close to full employment. And both of the numbers were something that would push them to lower rates more. And they were kind of surprising numbers whenever they came out. So I think a lot of optimism around lower rates, maybe even greater than this 70 basis points reduction.
Didn't we, so we just had a rate drop last week, right? And
Mhm.
then
Mhm.
they anticipate another one in mid-year. I think I was reading. Maybe I'm incorrect on that. Um,
I think maybe even sooner, because the Fed
okay,
meets like maybe
every quarter I thought.
it's a little bit more than every quarter. I can't remember. Let's see. I can see what the exact dates are. Jeff, if you want to talk about any other data, I can pull that up real quick. But I think they normally meet. It's more than let's say they have 8 plan sessions next year, so
Okay.
a little bit more than every other month. But they have one in January. Let's see, skip February, March, April, June, July, September, and October, along with December.
Yeah, and
Yep.
and I know you know this, Derek, but I know a lot of folks. And just talking to my loan officers, they tell me they have conversations with borrowers that try and time their refinances after Fed meetings. So just to be clear, while the Fed meetings and the interest rate, it does play an impact in interest rates. The bond market is trading constantly, and that is what decides interest rates. So it's almost like a lagging indicator. Now, if they make a move that is unexpected, if they raise when they thought they were going to hold or vice versa, then you'll see a big move. But if they do what is predicted, typically you don't see much of a move at all the next day. It's really kind of it's based on inflation and a lot of different factors. So just if you're a consumer wanting to talk about refinancing or buying properties, I would not plan I would not plan your locks or anything like that around rate drop day. It doesn't always doesn't work that way. Many times it's been dropped and they didn't drop it enough, and rates will shoot up right after a rate is dropped. So it's a little more complicated than just whatever Jerome Powell says or does.
Yeah, it's like if all the analysts say Apple is going to have a certain amount of earnings per share, and then the ending numbers end up being less than that. Even though it's a
Everyone
positive
loses their
number,
mind. Yeah.
yeah, people are going to pull the price down because it's not up to expectations. It's the exact same thing with the bond market. So it's
Yep.
a good point, Jeff. I mean, in our honest opinion, we just typically say just handle investing in real estate like you handle investing in the stock market. You're probably putting money into your 401k. Hopefully every month you just kind of sit it and forget it and don't really worry about it. I mean, trying to time the market in real estate is really, really complicated. And more often than not, if you think everybody's scared, even though that's a scary time to do it, like Derek said earlier, uh, it's the time to go. Whenever everyone else is nervous, it's the time to go. There's a lot of different Buffett quotes on that one. One is the time to buy is when there's blood on the streets. There's all kinds of other ones, but don't try to time the market. Don't try to only do it whenever there's tons of positive momentum. This next slide.
It's hard. It's hard to go against the stream, but it'll serve you well.
For sure. So
We skipped one. Was there one before that? Am I
oh,
tripping? David, was there? Oh, okay.
okay. Yeah, you're right.
There it is. Wait.
Yep.
Okay.
We
All right.
went through it again. There we
There
go.
it is. That's
There we
it.
go. Yeah, so this is a good chart where home prices are expected to either drop or go up. And green as is commonly the case, is a good indicator. And while the major metros in Texas are not the darkest green, there is Realtor.com, also very credible organization, is anticipating the major metros to go up about 5% each. And that's pretty exciting numbers. We'll go into why that is happening out there. But this forecast was talking about 22 select cities to see values drop, and none of those are in our major markets, right?
Yeah. The interesting thing I thought was like a lot of the red is in Florida, and they had during the COVID migration, they had a huge run up. Texas was good, but it was nothing compared to Florida. So I think they're pulling back.
Mm-hmm.
And I think a lot of the California green and New York green is probably because they had lost so much during the migration. It's only natural for it to come back up. But Texas being in the green, and there's a couple slides later, like it's just good fundamentals. It's population growth, it's job growth, and it's relatively steady real estate market. So I think of all these, green dot's great, but I think if you've been solid during the pandemic and adding bodies and people to stay that way is a testament to like the fundamentals of the economy here.
There's a reason why most of the hedge funds throughout the country are investing in the Sun Belt.
Mm-hmm.
It's stable as it comes. I don't really see too many swings.
Yeah. The population migration, that's a good point, Derek. The people who are really smart and are looking to invest at scale, that you're right, there are certain funds where they're like, we're only going to buy in these 12 states, and they all happen to be kind of in the south and southeast. That's very, very common. All right, next slide. What did you guys see on this one?
I think it's probably more for Derek because he talked about listings and delistings and people dropping out. So
Mm-hmm.
delistings up 45%. I do think it's interesting that the prices aren't dropping. I mean, Dallas is obviously, but I'm focusing on Houston. Like I'm sure delistings are up in Houston as well. So prices aren't dropping so much, but people are just pulling their deals off the market.
Yeah,
Are you
I
getting
think
all of
it's
that? Where like when you make offers,
yeah,
or they just say,
yeah.
you know what,
So
screw it, I'm out. I'm not going to sell.
It kind of ties into what I was talking about before, about it's a combination of sellers' expectations and then also realtors not inability to guide their clients in a quick enough manner. The problem that I'm seeing throughout the market, and even in the two flips that we currently have, is that I bought those deals and I wasn't quick enough to get the renos done. I actually delayed on two of them about 2, 3 months. So I bought them on January numbers last year and listed them 2 months ago, and the numbers are not the same. And so, I anticipated it right away and just slashed the prices. And I'm getting a lot more action than in the previous. But I'd anticipated, for example, one of them is down in Santa Fe, new build area. Had anticipated a number of 299, worst case. 315 is where we listed it at, and I had two showings on it in a month. So I just cut it to the worst case scenario, 289, about a week ago, and I've had 8 showings on it so far. And so I think it's a matter of, and I did want to talk about that in a market like this that is challenging, where you're going to have a lot of inventory because of either expectations or the realtor's pricing. You need to make sure that you have the best product. And what I mean by the best product is making sure that if you're doing a flip, that little items, you want to have things show clean. You don't want dirt on the floor. You want to make sure that it maintains a good appearance, because you only get one shot on some of these buyers whenever they walk in, and you do not want to have a listing with clutter or sloppy paint or things that should have been done whenever you're putting that product on the market. So you may want to make sure that you're walking it a couple times, make sure that you get a pre-inspection before you list it. That is something that has significantly saved me a ton of money. Just pay the $500 or so to have an inspector go out there, review the house before you list it, fix those items before you list the property and have an inspection done. I can't tell you how many times I've listed a property, actually got it under contract, and then the inspection has come back and it's lit up like a Christmas tree, red, deficient everywhere. And I go line item by line item, and it's maybe $1,500 worth of things, but it's got 30 or 40 different items on it. And it just looks horrible to the seller, and they terminate. And there's nothing you can do to like curb a cautious seller with something that looks so bad, even though you as the investor may be, oh man, that's a doorstop and that's a hinge and a anti-siphon, out on the outside that you always get. You always get the consistent same things from the inspectors. So spend a little bit of money and make sure that those safety items are taken care of. Make sure that the paint, make sure that you have all your cracks on the exterior filled. Little things like that, caulk your windows, make sure that the windows open and close, make sure that you have enough fire extinguishers in the house, and that that's no leaking, and that it has enough pressure. Those are things that you can just go over and get done in a day or two. And it can be the difference between busting out on a contract and having that negative stigma on your house, or actually selling that deal because it looks much cleaner to that person reviewing that inspection. So now is the time to definitely do that. Can save you a lot of headache.
That's great advice, because I think a lot of people's, whenever they're looking to make a purchase, whether that be an investor making a purchase on an off-market deal or borrowing from Catalyst, people are looking for things that give them a reason to not do it, right? That's just how people are. Most people make fear-based decisions. So it might not be anything of consequence or expense that's going to cause people to get nervous, but going through that process makes a huge difference. Because to your point, might not be that much money, but it's 15 things. And they think, wow, if this guy really considers himself to be a good flipper who cares about putting out a quality product, why did he miss so much, right? And what's not on this report that maybe was missed?
I can't see
behind a wall. Yeah. I can't see. The inspector can't see. So taking that effort it's just a great point. That's super important.
And it's only, most of the time it's just like punch item things that you've already paid to get done that they've missed. And it happens every single time. I cannot tell you how many times the same things happen over and over and over, because I feel like the inspectors are taught to find those specific items. And no matter if you got a 70s, 60s, 80s home, those issues, it's it's a 50-year-old home. Those issues are going to be there. So just put that caulking up on the window, fix those cracks in the exterior, make sure that the window works, unclog that drain. Because if someone sees a drain that's draining slow, oh my God, the pipes may not be working. And you're like, well, no, it's, the 30 years of buildup and you actually replaced it. All it is a snake. You could make, you can head off those concerns that buyer is going to see on it anyway. Right. So,
A $300 snake, or sometimes it's just a $10 bottle of Drano. It's just simple things that can make a big difference. One other thing I would advise people, because I have sold a couple properties recently, is if you get a list of things, like a list of 8 things that somebody wants you to do, right? I just make it a commitment that I'm going to say yes to at least half of them, because and normally those half, they're super cheap. Like
yeah,
literally, to your point, probably it's something the contractor is supposed to do anyway, and you're not going to pay anything for it, or it's going to be hundreds of dollars.
yeah,
And so you just knock those 4 out for sure. And then anything else that seems reasonable, try and do it too. But if it's a big expense like a new roof, just say you're going to send somebody out for a roof service, or something like that. You don't have to spend 6,500 typically,
yeah.
unless it's horrible. But make sure that you're above 50%, because you alluded to this earlier, and I think it's an important point. Once your home goes back on the market because it fell out, that's a black eye.
Yeah.
You're gonna
And a lot of times people don't realize that you have to turn that inspection in as a realtor to that next buyer. Even if you fix those items that show up, you're going to have to instruct your realtor to, hey, mark those things as completed with photos and show it. And then you're going to have that inspection showing there as that it was deficient in the first place. So it's, I always say, if I have someone bust out of contract with me, I kind of want to know that list, but I do not want to see that inspection. Don't send me the inspection. As soon as you see the inspection, you have to present it. Just let me know what items why you're terminating, and then I can go and investigate it a little bit further, but do not send me the inspection. And I also want to see, like you said, Wade, I want those items like that. To me, I want that list. I don't want that termination. So send me everything that you can do, and we can negotiate. Because that's part of the deal that you do. Don't terminate, please.
Yeah, don't terminate, and just find a way to make it work, because your holding costs, you're going to have another, 30, 45, 60 days of holding costs. If you're using hard money, that's not a small amount of money. Plus you got taxes and insurance. Your property could get vandalized. It could get robbed. Someone could steal your appliances. Like, there's a laundry list of things that could go wrong in that time frame. My opinion, make that deal happen. If it costs you an extra 15 to 2,000 that you didn't think was going to happen. Hell, the other day I just changed the roof entirely on a property,
Yeah.
because like it looked bad. We didn't catch it up front. It was bad. It's going to come up on every damn inspection that I have here going forward. Sometimes you just have to say it is what it is, and I just have to move forward and make the right decision, even if it hurts.
Yep.
All right, let's see this next slide. So this one, is it a good time to buy a house? That's a question. Yahoo Finance, also a very credible source, says that as of the second bullet point, in November, 18% of listings featured price reductions. I told you that's definitely some indications of a buyer's market. But if you look at the peak competition, that's an interesting data point too. Back whenever things were flying off the shelves, 58.8% of homes sold above list price. Low point was shortly after that, right whenever all the feverish things were happening, rates were going up, people pulled out. But right now, it's about 25.5% of those deals that sold above list price. So it's still, I mean, candidly to me, even being 25.5% above list price, a little bit of a surprising number, but tells you there's some resilience in the market. Anything else you guys see here?
I will say that the higher end price points, I know the data doesn't show it, but the homes that are above 350, 400 in decent areas, they are, from my experience, are not really being affected right now. Because those buyers are a little bit sometimes more qualified than the people who are really getting hit by the inflation and stuff like that. So, don't be afraid to, if your specialty is the high end stuff, to not just be like, oh my God, the entire market's collapsing. Just you really have to be neighborhood by neighborhood specific whenever you're evaluating these deals because, certain neighborhoods have forest, woodlands right now, and certain pockets of the woodlands are still going above list multiple offers in those very good school zones. So don't be afraid to invest in those areas.
I think it goes back to your point about just doing a really, really great job on the rehab. That's the thing. Like you have to do a great job on the rehab. Don't miss anything. And you're right. We have a couple of customers that do this exact thing. They do a lot of relatively high end. I'm not talking millions, but we're talking, mid four, five, six, maybe even sevens. But they just do a great job on the rehab, and their stuff sells fast, and they make money. So you're
Yeah.
right. You can still sell deals at that price point.
Make sure you're picking the right materials. That's a huge thing. People think just because it's clean that those people who can afford those four, five, six, $700,000 homes can tell the difference between quartz and granite. Um, so just make sure you're picking the right materials, the right baseboard heights. Don't just try to save a few $1,000s by doing those things that are, and then where you can make money, those accent walls or those Kat and I do. Kat does a very good job of finding those, restoration hardware dupes and stuff like that. You can literally throw it in a chat GDP. Hey, find this thing cheaper, buy it on Amazon. And, we've had so many compliments on the higher end stuff because we're buying stuff that's looks like it's $4,000, but it's only, 800. Right. So there are ways you can save money in different manners.
Yeah, and your appliance package, those things that just jump out at people, like, you have Wolf range, you have Sub-Zero refrigerator, if you're in those price points. And you can often buy those at a discounted price as well, right? You could buy something that was a floor model or something like that, still, in pristine condition, but or it's just on a discounted rate, like it's 20% off. They have some Black Friday sale or something like that. And you can have amazing appliances that really jump out at people, but you don't have to spend quite as much money on it. But if you think about it, you could use a basic appliance package. It costs you an extra 10 grand, maybe. But
Yeah.
in that price point, if you don't have it, if you have basic stuff, it's going to be very difficult because that's so obvious to the eye.
And I suggest everyone get the Best Buy. If you have credit cards, get the Best Buy credit card. That APR, 0% APR for 18 months is, I use that for all our packages and stuff, even though it's on my personal one. I don't like doing that. You can't, it's, paying something off in 18 months. Obviously, you weigh what's good with your debt ratio and stuff like that, but it's a no-brainer sometimes.
And they have a that Pacific or whatever, I can't remember what it's called, but they have like a high-end appliance deal if you're doing high-end flips there too.
Yeah.
That has some really good prices. All right. Let's see this next slide. I thought this is interesting, but considering time, let's see which slide, which page are we on? There's some others that I thought. Let's go over the migration data if that's okay. What did you guys see in this migration data? Because this is a big reason why we believe Texas is, a very positive place to invest going forward. What do you guys see here?
Yeah, I mean, this is what I was talking about earlier with the green dots, where Texas has been consistently migrating net positive for quite some time. They come here for a lot of reasons, right? The fundamentals, jobs, good, low cost of living, weather. It's a little hot, but it's just it's when you have business friendly government and
Yeah. We're a red state.
yeah,
Politics
yeah, it's
aside,
just
being a
there's a
red
ton of
state.
reasons why people are moving here, and they keep moving here.
Yeah, that's a big number. Like Texas is not the most populous state, but consistently the most net migration. This has been going on for years now. To your point, I mean, you can debate, politics or whatever the case may be, but the raw numbers are the raw numbers. And if you're making
Yeah.
investments, you just have to go with the raw numbers and understand that supply and demand is the bottom line for prices. And if there are more people moving into the state, then prices should continue to, go up over time. Even though we're in a less than positive rate environment, whenever rates come down, because there really haven't been big drops while rates are up, I think there's a lot of momentum that will be had in 2026. You alluded to this earlier. Derek, talk to us a little bit about what you're hearing. I know sometimes you'll probably sell to these private equity groups, but what are you seeing in this data? What are you seeing or compete with them?
Yeah. Yeah, I mean, from the larger fund perspective, everyone pulled out last year. from those funds that we were typically able to buy from. They started pulling out because a lot of their money is based on that Wall Street money. So if they don't have the money that they can raise, they're not able to buy. I will say that Texas is one of the first ones that will turn get their doors back on. So, Open Door has started buying again. To me, I don't know how Open Door makes any money, but that's for another day. But they're a good indicator if there's some money coming back in. OfferPad is starting to come back in the marketplace, dipping their toes into certain things. Wedgwood, another large private fund that does some higher end stuff. They're starting to dip their toes back into the marketplace and do that. I don't really anticipate it until probably the first or second of the year, whenever they start trying to buy again, because they're always lagging a little bit. But
If you look at the time frame, it does look as though, while 2025 is a long time frame, and this is looking at years and half years. 2025 is an uptick for sure from where we were with the private equity investment. But it sounds like you're feeling in the second half of this year, it slowed down a bit, right?
yeah, 2024, in the middle of the year, I have a few contacts that they were like, "Hey, we're not buying anymore," and they were very scared of like what you guys are saying about the feds were saying that they weren't going to lower their rates and stuff. So because their money's institutional, everyone was going, "No, I'm not investing. I can't raise any more." Um, and then they do a good job of anticipating future stuff because they have a lot of data. Um, but they're, obviously going to be overcorrect sometimes, and not super market specific, because if institutional buyers, if you're trying to buy 2,000 deals, you can't be super specific on the areas that you're at and at scale. If you lose on one deal, you kill your, you know you kill your return over 10. So it's very interesting.
For sure. All right. Jeff, what do you see on this slide? Some interesting vacancy data.
Yeah, so I mean, we cover this relative to the thought being, if it's easy for everybody to buy a house, you're going to have rental vacancies go up and vice versa. And you can see lately it seems like it has been getting a little easier to get into properties with rates dropping. So I would expect that number to go up quite a bit. I'm sorry, not quite a bit, a little bit as this year goes, and if rates drop, in theory, it should be a little easier for people to buy houses. So I would think the rental vacancy will go up a little, but it's not too complicated. Derek, we covered this one quite a bit. A lot of rental vacancy is pretty high when you can get three houses on stated loans being a janitor, and then as the government tightened up their lending rules, you can see that just dropping pretty significantly.
Yeah, I mean, from the sale perspective, we were doing a lot of FHA loans, and I'm not seeing as many recently. Was interesting to see if maybe the qualifications have changed, or inflation has really affected those people.
When were you doing more FHA? What's the timeline there?
Last year, we were doing a
Last year?
ton of
Okay.
FHA.
Interesting.
And whenever they raised their floor for that FHA, because it's now 350, if our average home sale is 410 and we're dealing in sub 300s the majority of the time in investment world, you're going to have a lot of FHA. And it became obviously FHA is less desirable than typical conventional, because a lot of times the people aren't as qualified. But it also if you have a good agent who can do FHA, I would definitely say don't steer away from FHA.
Yeah, my perspective on it is we did a lot of those price points where FHA was common. Couple of pro tips to your point, Derek. They're only sometimes having to put down 3.5%, so it's a good product for them. But to your point, sometimes they don't have as much money, so small changes might cause them to become disqualified. The other big thing is that the FHA appraisal is far more rigorous than a conventional appraisal. So your technique of doing a pre-inspection is super critical, because they're going to find more things. Both the appraiser is expected to check mechanical things. That does not happen on conventional loans. So they're going to check things like water flow and the HVAC system and other stuff that's kind of unique. And then also if the borrower does an inspection, they may find some other things there. But even the appraisal itself is going to be a different inspection from the appraiser's perspective. So important thing to keep in mind. If I had my druthers, in most instances, I'm going to go with I'll go with VA first just because I want to support the military. But then, secondly, I really like the conventional loans because it's not as rigorous of an appraisal. They're normally 20% down, and maybe it's just not as likely that they're going to fall out. But there's a lot of price points where you're just not going to get that in certain markets. You're going to have to deal with FHA.
Yeah.
All right. Last thing, the affordability index, and then we'll wrap it up. Maybe ask for a couple questions. We're right up against it. I know we cover this a lot of times, but for those of you that don't know, look at this. I always like to look at the San Antonio numbers because it's such an affordable market. If you look at the income in San Antonio versus Houston, they're almost identical. In fact, maybe for the
Higher.
first, San Antonio is higher, but look at the price point of the homes, almost $85,000 less. So I think Jeff alluded to this earlier. That's one of the big reasons why it's going up there. I think there's a lot of room for growth there in San Antonio. So it's a good market overall. Anything else jumping out here, gentlemen, before we turn it over to David for some questions?
No, it's good to have all those markets in the top 100 done.
For sure. All right. David, do we have a question or two today?
Yep,
David?
sorry about that, guys. So we did have a question. Basically, we're wondering about the DSCR products. For a DSCR loan coming out of a hard money loan, is there a seasoning period?
No. If you're just doing a straight refinance of a hard money loan into a DSCR, no.
There are some, to be full disclosure, there are some lenders that have it. Catalyst does not. Back in the day, whenever we broker deals like everyone else, there were some that had a 3 or 6 month seasoning period, but we have acquired far better options, and we have many that do not only require seasoning, but don't even require the property to be leased, which is very good.
Gotcha. And then one just kind of generic question that I saw is what makes a property a good investment in your eyes? What are the things that you guys look for?
I'll let Derek speak to
I mean, that's a loaded question. A good
that.
invest. It depends on what your strategy is, right? And it depends on how much money you have. If you're just getting into real estate, I would say for a newer investor, it's good to, do something that you feel like you can handle within a reasonable scope of work, meaning that it's going to be close to you so that you can monitor it, you can drive to it, and then the level of rehab is going to be within um, something that you can handle with a newer contractor. I would suggest getting a new contractor or a contractor that's experienced on your first one to be able to help you, and then for rentals and stuff like that, it all depends. Same thing. You want to have them close to you that you can get and monitor for your first couple deals. But it really depends on your end goal of what you're trying to do. As you accumulate more deals under your belt, I have tended to go into the realm of I shoot for home runs now, just because it's what I look for where there may be a gap in the market, but you have to kind of get to the point where you have enough experience to be able to shoot for those missing gaps. And what I mean by a home run is just something that is, you know, our return is going to be worth the time that we're going to spend on it. And it can either be a quick wholesale per se, where you're just doing a quick flip and throwing it back on market with some lipstick, or I really like trailers with land recently on them, under 2 acres. It's been very good to us. So it's kind of just following into what your niche is and what you're comfortable with after you've done a deal or two, and go from there.
Nice. Very nice. All right, David, I think we're well beyond time now. How about we just announce our winner and let Derek let everybody know how to reach him.
Absolutely, yeah. Our winner is going to be Patrick Cumming. Thank you, Patrick, for tuning in.
Absolutely. And Derek, we see some info here. Anything else about reaching out to you? Do you have any other events coming up or anything that you want to make people aware of?
No, but the first of the year, we're going to be doing a bunch of volunteer events, a bunch of networking events. So we'll probably get y'all that information. Go to the vicinarealty.com, fill the information out. If you're an investor, one of my agents will reach out to you. That is our company number. If you need my cell, I'm happy to share it. It's 832-389-6058. Give me a call, text, anytime. I can share that as well. If you put an application, like if you put in a form or something like that, I will see it after this, so I can make sure that I reach out.
Awesome. Well, Derek, thank you. You had a lot of great insight. That was awesome. And
Thank you guys for having me.
yeah, for sure. To everyone else, have a safe and happy holiday season. Happy New Year to you. Have a good one.
Thanks, Eric.